Good afternoon, Patty. I hope you are doing well. Today, we're going to talk to you. We're going to talk about the buying your first home from the perspective of a buyer. So, I am Joe Mendez. I'm with Coldwell Banker Coastal Alliance, and I work in the Long Beach area. But I also have worked all over Southern California, both helping sellers and buyers in purchasing a home. And you want to introduce yourself, Patty?
Hi, I'm Patty Gadd. I'm with New American Funding, and I help people throughout the United States actually to get home loans to buy their dream homes.
Awesome. You and I have worked together for many, many years in both trying to get multiple buyers and trying to get qualified and purchasing their first home. So the topics that we are going to talk about today are this. So the agenda for today and the discussion points will be as follows. So why don't we just go ahead and start? Um, so what are the requirements to get approved for a mortgage loan?
Well, to get started on getting a pre-approval for a mortgage loan, I ask for 30-day paycheck stubs, 2 years W-2s if you're employed. Self-employed people need to provide 2 years tax returns, and then 2 months bank statements. I then run your credit and then determine what your sales price is that you can comfortably afford. How I like to work is I tell my clients, I approve you for the highest amount that you can go. You might not like the payment. You might want a lower payment, but for instance, if you're out looking at a home for $350,000, but you know you can go to 400 and you don't like anything on the market that's 350, then you can pop up to 395, 400,000 and look at something comfortably and know that you can afford it. And you're not looking at or falling in love with a home that you can't afford.
Okay. And what about the types of loans that are available today on the market?
We have a variety types of loans. We have loans where you can come in with as little as 3% down. We have first time buyer loans, of course, where they will, depending on your qualifications, there are some restrictions in first time buyer programs, but they will help you with some down payment and closing costs. And then we have VA loans, FHA loans. We'll go a little bit later into those loans, but there's a variety of loans to help you purchase a home.
And just out of curiosity, on the 3% loans, are those conventional loans? Is that a conventional loan?
Yes, we have conventional loans that are the conforming loan amount. There's a conforming loan amount and then there's a high balance loan amount. Conforming loan amounts go to 548. And then over that are considered high balance. So in the conforming loan arena, you can come in with as little as 3% down.
Gotcha. Okay, and then I get this all the time. What's the difference between pre-approval or a pre-qualification?
A pre-qualification is just a thumbnail sketch of what you make and what your debts are. A pre-approval is more in depth. We actually do and can submit your loan to an underwriter where they will actually put it through the underwriting system to get you pre-approved or approved pending on the property that you're going to buy. So then when you go to purchase a property or put an offer in, you're stronger with a pre-approval or approval letter that you're already approved. And your offer stands out more than just a pre-qualification. Pre-qualifications, there could be things that pop up that a lender doesn't know because they didn't ask the right questions. Pre-approval is more in depth of your finances and your credit.
And so does doing a pre-approval, would that shorten the process, or like once we go into escrow?
Yes, it does, because what we've done is already run what's called direct underwriting. And so we have that approval. So from there, and we have all of the documents, And if we don't need to update any paycheck stub, if you find a house within the 30 days that we need the paycheck stubs, we can go from there into processing, into underwriting to close escrow. And in, as you know, Joe, in this environment, you want to shorten your escrow time to be more competitive in the market.
I know that for me, as an agent who works with buyers, having a client that is pre-approved speeds up the process. And honestly, it also saves a lot of stress, because if someone's already pre-approved, it's less paperwork that they have to submit quickly and rush a process. So I definitely think pre-approval is the way to go.
That's right.
What about options that are available if someone does not qualify?
Well, there's a couple options. The people can always get a cosigner to help them, even if they have a parent that owns a home. Their parent, if they agree, could co-sign for the property. They could get gift money from a relative to help them with more down payment. For instance, if they have 3% down and they're not quite qualifying for the home they want or condo, then they can get a little bit of gift money for more of a down payment that could help them then qualify.
That's great. That's good to hear. And then, the big question, of course, that everybody has been talking about lately is interest rates. How does a first-time buyer get the best interest rate?
Well, really, for anyone to get the best interest rate, they have to have a good credit score, anything over 700. Interest rates also vary on the loan to value, how much money they're putting down. If they're putting more money down, they could get a little bit better interest rate. But mostly it's the credit score that helps with a good interest rate.
Okay, awesome. So let's see. And then obviously we've already introduced ourselves, but again, I'm Joe Mendez, and I'm with Global Bank Agricultural Alliance, and Patty Gadd is with New American Funding, and she's a senior loan officer. So here are some other requirements that we can maybe talk a little bit more about, which is income, debt ratio, and FICO score. So I'll let you take a shot at that.
Well, there's a lot of misinformation regarding income, debt ratio, and FICO scores because of the different types of loans that people can qualify for. Those will all vary. For instance, FHA loan, you can come in with as little as 3.5% down, and you can have a credit score as low as 580. And also the debt ratio. A debt ratio is when you put all your consumer debt that you owe and your new house payment, and that is calculated, and that is what a debt ratio is. So for instance, on FHA allows you to go to a 55% debt ratio, meaning 55% of your income can go to housing and debt. On a conventional loan, the debt ratio then is 45%. So it's a little bit lower. You could get actually more higher debt ratio on conventional, a little bit, maybe 48%, 50 max, but then you're going to have to show reserves, meaning you're going to have a couple months of house payments left over from your closing costs and your down payment to show in the bank.
But how do you, those reserves can be in the form of, it doesn't have to be in money and savings. It could be
in 401k, it could be in stock, it could be in non-liquid
if they own if they owned investment properties, for example, would that qualify as a, would you be able to count that as?
No, investment properties would not count. The investment income, and if they have it somewhere, if they had a rental account that had investment income in it, we could use that as reserves.
Okay. And then you sort of kind of went already into FICO scores already, but one of the things that comes up for me all the time is buyers will oftentimes do their FICO scores on their own by going through some website and they come up with scores. But that's a little different, isn't it?
Yes, it is. Credit Karma is a good example. Everyone says, oh, my Credit Karma score is 780. And then I just bought a car and my credit score from the car dealer was 780. And then I run their credit and it's lower. The difference is there's there's A, B, C, D of credit scoring. Credit card people, they pull one credit, Equifax or TransUnion, they pull one bureau and they don't go into depth. So that way the credit score is always higher. When you're applying for a loan, any lender has the credit bureaus. They pull all three credit bureaus, and they actually are now going back 10 years. And the algorithms do something, I don't know what they do, but they've changed them a lot where they've tightened them up. So the credit score is then calculated in a total different way, but more in depth than Credit Karma is showing or what the car people are showing.
Gotcha. All right. Well, thank you for that. I was just going to ask one more final question regarding the debt ratio, because you mentioned consumer debt. So consumer debt is like credit cards, right?
Credit cards, car payments, student loans, that's all considered consumer debt.
But when you look at that debt, are you looking at the overall debt amount, or are you looking at the monthly payment for that debt?
We only look at monthly payment for that debt.
Awesome.
So if you have a credit card, a lot of people say to me, oh, my credit card payment is only $27, but I really pay $100. Well, and that's great for them because they're paying it off faster, but all I care about is that $27.
Gotcha. Perfect. Awesome. All right. So let's see. Let's go on. So you've kind of touched down on this a little bit, but what are the types of loans that are available again?
There's FHA and VA. FHA is the 3.5% down with the higher debt ratio. It does have mortgage insurance. And then VA, of course, for veterans, it's an awesome program where you can come in with no money down. And the seller actually helps pay some of your closing costs with that type of a loan. And then there's conventional, where you can come in with as little as 3% down. And conventional loans the interest rates are excellent on the conventional loans. And the FICO scores, though, are 680 and above. Really, we can do a 620 conventional loan, but the interest rates are not good. So if I had a client that was a 620, I'd move them over to an FHA loan. And the FHA loans are great too, and the VA loans as far as rates, but they do have higher mortgage insurance than conventional loans.
Awesome. And so I know you're going to talk about the 20% down payment as well, but I think it's worth mentioning that on both FHA, VA, and conventional loans, unless they put 20% down, there is going to be PMI. So do you want to speak a little bit about PMI, what that is?
Right. Mortgage insurance is a monthly fee that you pay until you get to an equity point of 80% loan to value, meaning there's 20% equity in the home. So if you put 10% down and in 2 years your property has gone up 10%, then you have the 80% loan to value, and then you can apply to get your private mortgage insurance taken off, or you can refinance to get it off, whatever works better for the client at the time. With 20% down, you don't need any of the mortgage insurance because the lender feels like you have enough money in the game that you're going to keep making your payments.
And one misconception I think that buyers have is that they can't buy anything unless they have 20% down.
That is so
it's
true.
Really not true at all.
No, that is so true. I have so many people, as you know, with our clients come to us and say, well, I only have, 25,000 or 30,000. Well, that's enough to buy a home. And if they're getting it out of their 401k or gift money or savings, they can get it. And the private mortgage insurance is, it could be a write-off along with your interest in your property tax. You'd have to check with your accountant. But the private mortgage insurance really is not that bad of a monthly hit. You're not going to want to buy the property. Most people are buying property without 20% down. I haven't lately seen a 20% down buyer.
Well, as a first-time buyer, I know I was a first-time buyer once, and it's not easy to come up with 20% down. That's a lot of money that someone has to come up with. So
It is.
um,
That's why if, as a first time buyer, I obviously was, when I bought my condo, I didn't think I was ever going to be able to eat again. I thought I'd be on top ramen the rest of my life and sit on the floor, because it was just getting my little 5% down that I put down seemed like a lot at the time. But then as and every month I made my payment, which always surprised me that I could do it. But anyway, and then you have the equity, and you grow equity. You can refinance to purchase something else, or you can sell your condo to purchase a home, and you've gained all this equity instead of throwing it away on rent and paying the landlord's mortgage for them.
yeah, absolutely. I am one of those people. I did that, as you know. My first property, I did an FHA loan, and actually the loan was an adjustable loan, not a fixed 30-year loan, or the rate rather. And then afterwards, I refinanced to a fixed rate 30-year loan, and then eventually I built equity in my condo, which got me into my house today. And then, of course, I refinanced my house a couple of times, and I pulled money out, which allowed me to buy an investment properties, which is, I mean, I think that's another time that we can discuss some of that, how people can do that. So
Right.
I want to ask one other questions regarding FHA and primarily FHA. So a few years ago, I seem to recall that there was uh, what is it, a rule that if you did an FHA loan, you were locked in for the life of the loan on the PMI. That's changed now, right?
No, it's still the same. You still have the PMI for the life of the loan. That's why I can give you example after example of clients that have bought a property FHA. A year later, I've refinanced them into a conventional loan, got rid of their private mortgage insurance, and lowered their payment. Now, the interest rate could be a little bit higher than what they first bought with the FHA, but with the PMI coming off, their payment, it was $400 less than what they were paying originally.
So basically, I mean, I know you did a couple of those for my clients recently. So, and I seem to recall on one particular client, they saved almost $300 a month, I think, right?
Yeah, they did. They
Yeah,
did.
that's fantastic.
Yeah.
Awesome. Okay, so let's see what we go up to next. So we've kind of already talked about this, the difference between pre-qualification and pre-approval. So I don't know that there's anything else that we need to add to that, right?
Right. I think we're good on that.
And then you somewhat talked about this as well, but maybe we should talk, what are options that are available to someone that doesn't qualify? We did talk about this, but is there anything else that you want to add to any of these individual topics?
Sure. Well, working together to set up a plan. I love working with first time buyers, and they come in and they're nervous and they show me all their stuff. I do the pre-approval on them. And with the housing prices as they are, they can't quite qualify. They can't get a cosigner. They can't get gift money. So what we do is we work together to set up a plan for savings, and say, you might not be able to qualify for a home today, but 6 months to a year down the line, if you do these things, you'll be able to purchase a home. And it might be improving their credit score. It might be just saving money. As far as improving the credit score, we have a tool that analyzes the credit once we run the credit report, and it will tell you what you need to do, which debt needs to be paid down to bring your score up to a certain point where then you can qualify for the better rate. And we do that automatically, no cost to the buyers, of course.
So is
And
what is the most, not necessarily the most easiest, but how does a credit score change? I mean, can it change drastically if someone does this or that? I mean, is there an example that you can give that?
well, basically keeping your bills down and not maxing out your credit score, that's the best way to raise your credit. The other thing is, if you have collection accounts, and you can go back to especially medical collections, you can go to the collection account people and tell them you will pay the collection, and you could negotiate a little less or pay it off. if that's possible. But what you want is what's called a deletion letter. So many times the collection companies, because they're going to get their money finally, they will give you a deletion letter, which actually deletes the credit off your credit report as if it never was there. And I've seen people raise their score by $100 points rather,
Really?
by doing that. Yes, yes.
Wow. Does that have anything to do, that 100 point, does that have anything to do with the size of the debt?
No, not really. It's just if it's a collection. I mean, if you get rid of a couple collections, then it does help. If it's a recent 30-day collection, they hit you 100 points with that, or even a late fee. I had a realtor, actually, I was doing a refinance for, and she clicked on the wrong button for her Capital One and didn't pay the full amount. She had a 30-day late fee and her credit score went down 80 points.
Wow.
So she appealed to the credit card company, and they could see that she paid it and just made a mistake. So they did take that off her credit. So it's always good. People are so afraid to have their credit score run. They go, oh, my credit's horrible. And I can't tell you how many times I've run their credit and their credit's fine. I mean, it's great. It's not bad at all. And they just don't know what it is.
So again, talking about credit scores, because again, I know several people, including myself, who monitor their credit scores. So, and you mentioned Credit Karma. So if they check their Credit Karma on a monthly basis, for example, because I know they send out a notice every time there's a change, does that hurt the score?
No, that doesn't hurt it. That doesn't affect your score at all. The thing that affects your score are late payments, collections, excess, maxing your credit cards out hurts your score, and things like that.
And if you also arrive at a
inquiry affects your
also, if you arrive at a zero balance on any credit cards and then you close the account, that hurts you, right?
right. You have to, well, you can close some of them. If you have 15 credit cards and you're only using 5, closing those cards aren't going to help. But I've had people pay everything off to 0 and their score goes down by 100 points.
Gotcha. And then one other thing, another myth, I guess, is people say if they're applying for a credit for a mortgage loan and they apply through multiple credit companies, let's just say 2 or 3, does a mortgage loan and running their credit, does that hurt them?
Well, it really depends on the lender. And I have a lot of people call me and say, is this going to be a hard inquiry? Now, we don't do hard inquiries. We do soft inquiries when we first do it, so we can see eventually it will become a hard inquiry. But initially we just do soft pulls.
What's the difference between a hard and a soft pull?
A soft pull does not ding your credit with an inquiry. When we do the full gamut of a credit report, it is a hard inquiry.
But you don't do that until you're probably in escrow and you've started the application.
Well, we do it when not before we're in escrow, but when we start the application. We do the soft pull in the beginning to see what their credit score is. And if they're not looking, and then once they have a property, because sometimes it could take a couple months to get your offer accepted, as you know, Joe, then we can run the hard inquiry on that and get them rolling. But a soft pull will give us an idea of what the credit is, and it won't ding them. Hard inquiries are only like a 2-point hit on your credit. So it's not a big hit.
Awesome. Thank you. That's I think very good information for our buyers. So let's see. I think, what about interest rates? What can we say about interest rates these days?
Can we say interest rates are a little bit volatile right now with the way our economy is and going through all this COVID. And they've been down to 2.5. They've been back up to 3.5. So they're volatile, but we're still at historically low rates. Our rates have never. When I bought my first condominium, the interest rate was 15%, and it came down by the time I was ready to close my loan to 12.875, and I was ecstatic, just ecstatic. I could get that lower rate. So
I remember those interest rates. I remember like 18 or 19% interest rates that I'll never be able to buy a home.
Right. But interest rates are still at a historical low. prices, as you can speak to that, Joe, are going up and up and up. And it's a great time to buy.
So in terms of interest rates and in terms of, let's just say, well, first of all, what are the interest rates based on? Because they're tied to something, right?
Yeah, it's a little complicated. It's tied to the bond market. I mean, right now, it used to be in the old days before COVID, when the stock market was, unemployment was bad and the stock market was down, as loan officers would go, oh, that's great, because that helped the interest rates improve. But all of that has changed through this new economy that we're experiencing. So there's no telling what does, how the interest rates are affected.
But it's also worth noting, though, I think that interest rates don't drastically change easily. I mean, they don't go like a point higher. I mean, I guess they could, but historically that doesn't usually happen, right?
No, they're not going to go from 3% to 5%.
Right.
I mean, they could go to 5%, but that could be in 3 years from now.
Right.
So it just all depends on, where the economy is going and what's happening in the world. It's now, interest rates are now affected by the world economy.
Right. Absolutely.
Not just the United States.
Absolutely. Yeah. All right. So let's see what else. Thank you for that. Let's see what else we have. I think I think we're done. So this is your information. Your email address is there, Patty Gatt, and so is mine. And our phone numbers are there. We certainly would love to hear from anyone who needs help in applying for a mortgage. I know Patty and we work together. We've done many first-time buyer mortgages. Of course, I handle the real estate and she handles the mortgage part of it. But I know we both are willing to help, and I think at the forefront, that really is what we do well, right? We want to help someone get into a home. And if you have any questions at all, feel free to call, Patty or myself.
Right.
You want to add something at the end here, Patty?
Well, we appreciate your time listening, and stay tuned. We're going to do a series of these videos to inform you and kind of help educate you. So when you tip your toe in the real estate market, you will feel a little bit more confident on what you're doing.
Right. And, and if you have any topics, I mean, maybe that you might want us to talk about. I mean, right now, Patty and I talked a little before this, and, we'll talk about the escrow process, maybe talk about how do you buy investment properties from a mortgage perspective, self-employment, how, someone who's working versus someone who's self-employed, and just things like that nature. I will also say that I have a YouTube channel, so you can find me under Joe Mendez, and all of these videos will be posted on that channel. I also know that Patty's company, New American Funding, has a YouTube channel, and they often put very good information out there as well.
That's right.
Great. Thank you again for listening, and until the next time, have a nice evening.
Bye-bye.